GDP grew by 0.3% in October. That was slightly higher than the economist's prediction. And it was a fourth straight month of positive GDP for Canada. However, flash estimates for November are pointing to a slight decline. We're joined by Benjamin Reitzes, Managing Director of Canadian Rates and Macro Strategist at BMO Capital Markets. Benjamin, always great to see you. Thanks very much for coming on the show.
Thanks for having me, Andrew.
Is the Canadian economy slowing relentlessly?
No, I wouldn't put it that way.
Oh, okay.
I mean, the November number was soft, and I wouldn't put too much stress on that number because it's a very preliminary number from StatsCan. And if you look back to the October figure, they only thought the economy would grow 0.1%. It was 2 ticks better than that. And September was actually revised up. So the reality is, even if November was softer, October was better. September was revised higher. The fourth quarter had a good handoff, a better start. Maybe things slowed a bit in November, but I wouldn't put this in the down as a bad report.
I think I saw a figure suggesting that we're at, for the third quarter, we're at annual growth rate of 1.7%. Now, I might be off with that. How would you characterize that, though? Sort of steady growth, nothing spectacular?
So fourth quarter, I think, what you're referring to.
Okay.
Yeah, I mean, we were expecting, we have been forecasting 1.7% for a while. The Bank of Canada is at 2%, and this is kind of in that 1.5% range. That's where it's tracking at the moment. So it's consistent with kind of modest, decent growth in Canada. Things are not falling off a cliff by any means. GDP is up 1.9% year over year, so decent numbers. It's not great, but you have all these rate cuts that are in the pipeline that are going to have an impact over the next number of months and quarters. And so we do expect things to improve a little bit over the coming months, and especially with that tax break that's coming in December, that might have weighed a little bit on November as people delayed some spending until taxes were lowered.
Anecdotally, apparently some people are showing up at stores, returning goods that they bought and then rebuying them to get the tax break. So it is causing distortions for some retailers anyway.
It doesn't surprise me. That reality, I mean, if you think about it, it's a challenge to do that, logistically bring all your stuff back. But I thought about it as well. But what I did, I just kind of waited to make a purchase. I had to buy my son a birthday present. It was larger than I would have liked. And so it was like, all right, why don't we wait a couple more weeks and then we'll get it for you after the tax break. And I don't think I'm alone in that. And why not save those extra few cents heading into the holidays?
Sure is nice buying things without having a tax loaded on at the cash point. Yeah. Other countries put taxes into the prices, but we have to do it the way we do it. Yeah. Anyway, that's another day's work. What about the labour market as we move into 2025? Is it going to be tough for job seekers?
So I think that's the one area where things are much tougher, and we've seen the unemployment rate move up pretty substantially. If you look at it from a longer historical point of view, the unemployment rate isn't that high, but we are well off the lows from the post-pandemic levels. And so the labor market has softened a lot. With that, though, wage growth has stayed really strong. And so that's something the Bank of Canada has definitely had watching very closely. As the latest wage growth number from the payroll survey was north of 6%, was a record high if you look on the fixed weighted metric. And so that is an issue, but the labor market is problematic for Canada. Slowing population growth probably will help on that front, in that you'll just have fewer workers coming in the market. So that should help a little bit to slow the increase in unemployment. But we're anticipating that firmer growth driven by lower rates does help the economy and helps stabilize the unemployment rate at some point in the first half of the year.
Now, obviously, it's a mug's game trying to predict exactly what Donald Trump will do about tariffs. But do you think we should be bracing for the worst here, at least in the short term, if he blocks Canadian imports?
Yeah, I mean, that's a really tough question, because you don't know what the tariffs will be it the rate, what they're focusing on, what they're targeted, if Canada retaliates. And so there are an infinity number of scenarios you can really look at. But what it is doing right now is it's definitely weighing on the Canadian dollar, and it's weighing on Canadian markets and sentiment around Canada as well, because you have this tail risk that is kind of unknown in size, hanging over Canada, looming over us, that would potentially be very impactful. If they put on 25% tariff to Canada, the economic damage there would be pretty substantial. And so you get reactions from the government, from the central bank, and the currency would clearly move a lot. And so that's what you're already seeing to some extent. That's why the currency is as weak as it is. At this point, you just kind of wait and see where things go, and maybe hope that President Trump's ire shifts towards somewhere like Panama, as we saw over the weekend.
Okay. Benjamin, thank you very much indeed. Benjamin Reitzes, Managing Director at BMO Capital